Have you ever stopped to wonder who controls all your money? It's a question that's been asked for centuries, and the answer lies at the heart of our financial system. The origin and control of money, a concept so simple yet so complex, is a story shrouded in mystery and intrigue. In the early days, money was tangible, something you could touch and feel. Gold, silver, and other precious metals were the currency of choice. But as societies grew and economies became more complex, the need for a centralized system of money arose. Enter the Federal Reserve, the central banking system of the United States, established in the year 1913. But the creation of the Federal Reserve wasn't a straightforward process. There's an air of secrecy that surrounds its inception. A clandestine meeting held on Jekyll Island off the coast of Georgia. It was here that a group of influential bankers and politicians gathered under the cover of darkness to design what would become the Federal Reserve. The purpose? To stabilize the economy and prevent financial crises. But the reality? The Federal Reserve has been given the power to control the money supply, effectively controlling the economy. And who controls the Federal Reserve? A group of private banks, operating with little to no oversight from the government. This raises a critical question. If the Federal Reserve is a private entity, should it have the power to control the nation's money supply? It's a question that sparks debate among economists and financial enthusiasts alike. But one thing is clear: the Federal Reserve, a system shrouded in mystery and intrigue, controls the money. And so, as we delve deeper into the world of finance, we must ask ourselves, are we truly in control of our money? Or is it controlled by a system designed by and for the benefit of the few? The answer, as we'll discover, is far more complex than one might imagine. The Federal Reserve, a system shrouded in mystery and intrigue, controls the money. Alan Greenspan once said, "There is no other agency of government which can overrule actions that we take." This statement underscores the colossal power and independence of the Federal Reserve, the central banking system of the United States. With the ability to influence financial markets, control the money supply, and set interest rates, the Federal Reserve operates with an unparalleled degree of autonomy. What's more, it's virtually unanswerable to any governing body. This lack of oversight and accountability is a fundamental characteristic of the Federal Reserve, marking it as a unique entity within the government structure. However, this independence also raises questions. How much power should a single institution wield? And who ensures that this power is exercised responsibly? These questions become all the more pressing when you consider the immense influence the Federal Reserve has over the economy. The Federal Reserve, a power unto itself, answers to no one. Answers. Central banking is not unique to the United States. It's a global phenomenon. Every nation, barring a select few, operates under the auspices of a central banking system. These institutions shoulder the responsibility of managing their respective economies, controlling money supply, setting interest rates, and ensuring financial stability. But here's where it gets interesting. Despite the multitude of currencies, the US dollar holds a special status. It's the world's reserve currency, the monetary bedrock that underpins global trade. From oil transactions in the Middle East to debt repayments in Asia, the greenback is the go-to currency. This gives the United States, and by extension the Federal Reserve, unparalleled economic leverage. It's like a global game of Monopoly, and the Federal Reserve is the banker. The decisions it makes reverberate across the world, influencing markets and economies far beyond its borders. The US dollar, the world's reserve currency, is controlled by the Federal Reserve. Our money today is backed by nothing. It's a bold statement, but it's also a factual one. We're living in an era of fiat currency, a system where our money isn't backed by a physical commodity like gold or silver. Instead, the value of our money is based on the trust and confidence we place in the economy. But there's a twist. In our current system, debt is treated as money. When banks lend money, they aren't handing over stacks of bills. They're creating digital credits, effectively conjuring money out of thin air. This debt then circulates as money in our economy. The implications are profound. Every dollar in your pocket, every dollar in circulation, represents a dollar of debt owed to someone, somewhere. It's a cycle that perpetuates itself, creating a perpetual debt machine. In our debt-based system, money is nothing more than an IOU. And that, my friends, is a reality that we all need to grapple with. Banks create money out of thin air. It might sound like a magic trick, but it's not. It's the reality of our financial system. Here's how it works. Central banks, like the Federal Reserve, can inject money into the economy by purchasing government bonds. This process is often referred to as quantitative easing. But the real magic trick happens in commercial banks. When you take out a loan, the bank doesn't hand you someone else's deposited money. Instead, they simply type the loan amount into their system, thus creating new money. This practice is based on the premise called fractional reserve banking. In essence, banks are only required to keep a small fraction of their depositors' money on hand. The rest can be loaned out, and with each loan, new money is created. The power to create money gives banks an immense influence in our economy. Banks, the creators of money, hold immense power in our economy. Inflation is the silent thief that robs us all. It's more than just a catchy phrase, it's a reality we all face. As central and commercial banks create money, there's more cash circulating in the economy. This might sound like a good thing, but there's a catch. The more money there is, the less valuable each unit becomes. This is inflation. Imagine a pie. The more slices you cut, the smaller each piece becomes. That's what happens to your money. As inflation rises, the purchasing power of your money falls. That $100 bill in your wallet, it's not worth what it used to be. And the consequences? They're felt in the cost of goods and services. Your grocery bill creeps up. Your rent increases. The price of gas, a cup of coffee, a movie ticket, they all rise. And while your money's value dwindles, these costs become harder to meet. Inflation, a consequence of our money system, erodes our purchasing power. It's a subtle yet relentless thief. Our system is built on a foundation of debt. This statement might seem stark, but it's the reality of our modern monetary system. Money and debt in this system are two sides of the same coin. Every dollar in circulation is essentially a dollar of debt. Here's how it works. When banks issue loans, they're essentially creating new money. But this money comes with an obligation to pay it back with interest. Thus, the creation of money automatically generates debt. And the catch? The system requires continuous borrowing and debt growth. As interest accumulates, the total amount of debt in the system outpaces the amount of money. To keep the system afloat, we need an ever-increasing supply of new loans, new money, and consequently new debt. It's a perpetual cycle, a hamster wheel that our economy is perpetually running on. In a debt-based system, there is always a need for more debt. Central banks manipulate the economy through interest rates. This statement might sound a bit abstract at first, but let's break it down. Just like a puppeteer controls a puppet, central banks can control a nation's economy by adjusting interest rates. This is their primary tool for managing inflation and fostering economic growth. When the economy is sluggish, central banks can lower interest rates to encourage borrowing and spending. Conversely, when the economy is overheating, they can raise interest rates to cool things down. But this power is a double-edged sword. Take the example of former Federal Reserve Chairman Alan Greenspan. In the early 2000s, he drastically cut interest rates to stimulate the economy. While this did spur short-term growth, it also inflated a housing bubble that eventually burst, leading to the Great Recession. This illustrates how central banks, through their control of interest rates, can create booms and busts. Their influence can have far-reaching and sometimes unintended consequences. Central banks are becoming major players in financial markets. Now, you might be wondering, how? Well, let's consider the Bank of Japan. This central bank has been buying up stocks, becoming a significant shareholder in many companies. Imagine that. A central bank owning a slice of the business world. It's not just about issuing money or controlling interest rates anymore. It's about direct involvement in financial markets. This shift has transformed the traditional role of central banks. From being regulators and guardians of financial stability, they're now active participants, holding substantial stakes in private corporations. While this gives them a measure of control over the economy, it also blurs the lines between public policy and private enterprise. This evolution of central banks' role is a fascinating trend to watch. Will they continue to expand their portfolios, or will they return to their more traditional roles? Only time will tell. Central banks, through their asset purchases, are becoming major market players. History provides us with warnings about the dangers of central banking. Thomas Jefferson, a founding father, once warned us, "The central bank is an institution of the most deadly hostility existing against the principles and form of our Constitution." He was keenly aware of the potential control and influence a central bank could exert over a nation's economy. Fast forward to the 20th century, and we hear echoes of Jefferson's concerns in President Kennedy's famous quote, The high office of the president has been used to foment a plot to destroy the Americans' freedom, and before I leave office, I must inform the citizen of this plight. These historical figures recognize the potential dangers of privately owned central banks. They advocated for government-issued money, free from the influence of private interests. Their concerns were rooted in the belief that the power to control a nation's money should be in the hands of its people, not private entities. History warns us of the dangers of central banking, but are we listening? So, who controls all your money? Now you know. It's a complex web of central banks, commercial banks, and the system of debt-based money. We've unraveled the mystery of money, from its creation to its global impact. We've seen the power of the Federal Reserve and its lack of oversight. We've discovered that our fiat currency is backed by nothing but debt, and how this leads to inflation and a perpetual need for more debt. We've seen the influence that central banks wield over our economy and their ownership of assets. We've heard the warnings from historical figures about the dangers of privately owned central banks. It's a lot to digest, but knowledge is power. We invite you to join the conversation. Share your thoughts and experiences. Don't forget to subscribe, like, and share. Until next time, stay financially savvy.